If you had $10,000 today, not extra money, not play money, but money that actually matters, money that represents security, opportunity, and your family's future, where would you put it? Gold or cryptocurrency? At first glance, the answer seems simple. Gold feels safe. Crypto feels exciting. Gold feels proven. Crypto feels like the future. But this decision is not just about choosing an asset. It's about choosing a strategy. Because the way you allocate this $10,000 reflects how you think about risk, about time, about stability, about growth, and most importantly, about responsibility. Because when it comes to family wealth, mistakes don't just affect you. They affect everyone who depends on you. Step 1. Define the role of money. Before comparing gold and crypto, you need to answer one critical question. What is this $10,000 supposed to do? Because money without purpose leads to confusion, and confusion leads to poor decisions. Is this money meant to protect your family from uncertainty, grow aggressively over time, act as a backup for emergencies, or serve as a long-term investment? Each goal leads to a completely different choice. And this is where most people fail. They jump into assets without defining the role. They follow trends. They react to headlines. They copy others. Instead of thinking structurally. Gold, the anchor of wealth. Gold has one of the longest track records in human history. Empires have risen and fallen. Currencies have collapsed. Economies have transformed. And through all of it, gold has remained. Not because it grows rapidly, but because it preserves value. Gold is not designed to make you rich quickly. It is designed to make sure you don't become poor suddenly. And that distinction matters, especially when you're thinking about family. Why gold still matters today. In a world driven by technology, it's easy to underestimate something as simple as gold, but its strength lies in its simplicity. It doesn't depend on systems. It doesn't rely on platforms. It doesn't need electricity or internet access. It exists independently. And that independence creates security. Because when systems fail, simple assets survive. Gold and inflation. One of gold's strongest roles is protection against inflation. When currencies lose purchasing power, gold tends to maintain it. Not perfectly, not instantly, but over long periods, it balances out. This makes gold a defensive tool, not for growth, but for preservation. And preservation is a key part of wealth, because there's no point growing money if you can't protect it. The psychological stability of gold. There's another advantage that often goes unnoticed. Gold is emotionally stable. Its price moves slowly compared to crypto. It doesn't create panic. It doesn't create excitement. It doesn't pull you into constant decision making. And that matters. Because emotional decisions destroy wealth faster than bad assets. The limits of gold. But gold is not perfect. It has clear limitations. It doesn't produce income. It doesn't scale. It doesn't benefit from innovation. And over long periods, its growth is relatively slow. This means one thing. Gold protects wealth, but rarely multiplies it significantly. Crypto, a new financial layer. Now let's shift to crypto. Crypto is not just an asset, it's an evolving system. A new layer of finance, one that operates differently from traditional systems. Decentralized, global, accessible, and constantly changing. Unlike gold, crypto is not rooted in history. It's rooted in possibility. The growth potential of crypto. This is where crypto stands out. Its upside is unmatched. Small investments can grow dramatically. Adoption is increasing. New use cases are emerging, and innovation is continuous. For someone starting with $10,000, crypto offers something gold cannot. Acceleration. The ability to turn small capital into something significantly larger, but growth comes with instability. The same factor that creates opportunity also creates risk. Crypto is volatile. Prices can swing dramatically in short periods. Projects can disappear, trends can reverse quickly, and without knowledge, it's easy to make mistakes. This makes crypto powerful, but dangerous. The emotional trap of crypto doesn't just test your strategy, it tests your psychology. When prices rise, greed increases. When prices fall, fear takes over. And most people react. They buy when it feels safe. They sell when it feels dangerous, which is exactly the opposite of what works. Without discipline, crypto becomes a cycle of losses. Stability versus opportunity. Now, the contrast becomes clear. Gold offers stability. Crypto offers opportunity. Gold reduces risk. Crypto increases potential. Gold is predictable. Crypto is uncertain. And both are necessary in different ways. The danger of extremes, here's where people go wrong. They go all in on one side, all crypto, or no crypto at all. Both approaches create problems. All crypto exposes you to high volatility. No crypto limits your growth potential. Wealth is not built on extremes. It's built on balance. Building a system, not a bet. Instead of choosing one, think in terms of structure. Your $10,000 should not be a bet. It should be part of a system that includes protection, growth, flexibility. Gold can serve as protection. Crypto can serve as growth, and together they create balance. Example, allocation thinking. Imagine splitting your $10,000 with intention. A portion into gold to stabilize, a portion into crypto to grow, not randomly, but based on your risk tolerance, your timeline, your goals. This creates resilience. If crypto grows, your wealth accelerates. If markets become unstable, gold provides support. Time horizon changes everything. Short-term thinking leads to different decisions. Long-term thinking changes everything. Over short periods, crypto can be unpredictable. Over long periods, its growth potential becomes more meaningful. Gold, on the other hand, performs best over long time frames as a store of value. So the real question becomes, how long are you willing to stay committed? Because time reduces risk, but only if you remain consistent. Family wealth requires balance. When you're investing for yourself, you can take more risks. But when you're thinking about family, the strategy changes. It's no longer about maximizing returns. It's about ensuring stability, reducing risk, creating consistency. Because family wealth is not about winning big once. It's about surviving over time. The hidden risk, no strategy. The biggest mistake is not choosing gold or crypto. It's having no structure at all. Random decisions, emotional reactions, inconsistent behavior. These destroy wealth faster than any market movement. Discipline over assets. At the end of the day, the asset matters, but behavior matters more. A disciplined investor with average assets will outperform an emotional investor with great assets every time. Final truth. If you had $10,000 today, the smartest move wouldn't be choosing gold or crypto. It would be building a system that protects, a system that grows, a system that adapts. Because wealth is not built on single decisions. It's built on structure, on balance, on long-term thinking. Gold gives you stability. Crypto gives you opportunity. But only together, with discipline, with clarity, with purpose, do they create something powerful. Not just growth, not just protection, but true financial resilience. And that is what your family's future actually depends on. And once you start thinking in terms of systems instead of single decisions, something important shifts. You stop asking, which one will make me more money? And you start asking, what protects me if I'm wrong? Because in real life, you will be wrong sometimes. Markets will move in unexpected ways. Assets will underperform. trends will change. And the goal is not to avoid being wrong completely. The goal is to stay stable even when you are. The role of uncertainty. Every investment carries uncertainty. Gold feels stable, but it can stagnate for long periods. Crypto feels powerful, but it can drop suddenly. There is no perfect asset, only trade-offs. And once you accept that, you stop chasing certainty and start managing risk. Because wealth is not built by being right every time. It's built by surviving long enough to benefit from the times you are. Thinking in layers, not choices. Most people think in terms of choices. Either this or that. But strong financial systems are built in layers. One layer protects, one layer grows, one layer stays liquid. Each has a role. Gold can act as a protection layer. Crypto can act as a growth layer. Cash can act as a flexibility layer. And when these layers work together, they reduce pressure on each other. You don't expect one asset to do everything, and that reduces bad decisions. What happens during a crisis? This is where structure proves its value. Imagine a situation where markets become unstable. Crypto drops significantly, fear increases. Most people panic. They sell at the worst time. But if part of your wealth is in gold, you have stability. You have something holding value. And that stability gives you options. You can wait, you can rebalance, you can even buy when others are selling. Without that balance, you're forced into reaction. What happens during growth cycles? Now imagine the opposite. Markets are expanding. Innovation is accelerating. Crypto is growing rapidly.